Hello, everybody, and welcome again to the Alliance Group podcast. And we are talking with Mr. Jack Waldron about infinite banking today. Been looking forward to this episode for a long time. Jack, first of all, thank you so much for joining us on the Alliance Group podcast.
Hey, my pleasure. Thanks for having me, Sam.
Absolutely, man. So infinite banking, this is one of the hottest topics, financially related topics, I would say, for the past couple of years. This has been the number one thing that people are Googling, that you see all over TikTok. Yeah. People want to know more about infinite banking, and that is why we're so excited to have an expert in infinite banking. Jack, obviously, you are talking about infinite banking every day. You've really made a niche for yourself in this industry as being kind of that infinite banking guy. So thanks again for joining us. Let's jump right into it.
Yeah.
Another word, another way that people have described infinite banking, another term for it has been be your own bank. So it really all comes back to how banks work to make money and why. Well, I guess we'll start here, Jack. Why do people use banks?
So that's a really good question. Mm-hmm. And in fact, I teach a lot of classes, and I always ask everybody in the beginning, do you use banks? And as you can imagine, everybody raises their hands, right?
You kind of have to.
And I also ask everybody, how many of you feel that banks use you? And everyone raises their hand, but this time a little bit higher. Like all of us kind of have this sort of feeling of like, I feel like I might be getting used, but I don't really know why.
Yeah, right.
Well, I've been there, right? So I've been in this industry for 20 years, and about 15 years ago, I was in a meeting with somebody that exclusively works with those that are worth like 5, 10 million or above. Mm-hmm. And for the first time, I had heard this topic, infinite banking, but 15 years ago, TikTok didn't exist. There wasn't social media, I don't think at all. And there was, basically just a little bit of information out there. But he took time and actually showed me why his clients utilized infinite banking or be their own bank. And I left that meeting feeling like, my God, like this is something that I wish I'd have known more of. Right. And I really want to investigate because I found out in that meeting, you don't have to have $5 or $10 million. I mean, obviously I have clients that have that kind of money and they love using this. Right. So I started my own account and I started it with $600. And that was my monthly budget. And then the idea was to put more and more away. But it was only after doing a lot of research and looking into the strategy and how to best maximize it and what companies to find it to use it for. Because, there's these multi-billion-dollar financial institutions and insurance companies and all these organizations that are out there that you can facilitate this with. And you've got to know what you're doing and how to do it to really maximize, this type of a plan. And so anyway, to your point, I always ask people if they're used to using banks and ask them if they feel like they're being used by banks.
They have this feeling that like, yeah, there's something they're doing that making a lot of money off of, but I'm not really sure I understand it.
Correct.
How do banks make money?
When I did research into this and you look at how our banking system works, have you ever heard the term fractional reserve banking?
Maybe.
Do you ever remember watching the movie The Big Short?
Yes, I love that movie.
So they kind of refer to it in that. And essentially what this means is, let's say you take $100,000 that you made from your income, savings, whatever, and you put it into a savings account, which is what most everybody does. Over 70% of Americans have all their money sitting in accounts earning a little bit of interest in a savings account because that's just what they know. That's what mom and dad told them to do. Grandma and grandpa, that's what everybody that they've known, that's what they do. Well, the way our banking system works is fractional reserve banking means that they can take that number and multiply it times 10, and that's how much money they can loan out. Because if you think about if they receive if you request a loan from a bank, where are you going to go with that money?
Probably back to a bank.
You're going to go deposit it at a bank, right? So if you think about so if they take your $100,000 as a deposit and then they loan out, a whole bunch of different loans, but it's $1 million loaned out, all those people are going to receive those loans and they're going to go put it in a bank. So as long as that goes back in the bank, the central banking system works and everything is fine, right? But if you add up the interest that those banks are making, think about that, right? So you put in $100,000, they're loaning out $1 million. Let's just say that they're making conservatively 10% on average, right? That's $100,000 that they pocket on your $100,000 deposit.
That's 100% return in 1 year.
And what did you get?
I got
in your savings account.
Maybe 4 to 6%, maybe.
Well, maybe if you had like a high yield savings account or a CD, but what most people have is just like a regular regular savings account. Yeah.
In many cases, nothing.
0.08% interest. You got $80.
Literally negligible. Yeah.
Maybe a toaster if you went to a, you know what I mean, like a bank that, is real generous when you open that account, something like that. So I would say they probably got a lot more out of your money than you did.
Absolutely.
And when I understood that and then started just researching again, how the banking system works and why it works, and found out that you could really start to make your money more work for you in these type of ways, that's where that kind of started that process. So I started for myself, and then as I saw that working, I immediately started taking it to my clients. And it's not necessarily a strategy for everybody,
right?
But for my entrepreneur clients, business owners, folks with higher level of income, not that there's a certain amount of money you have to make, but there's a certain amount of money that you have to, have above your bills, right? So you can't be living paycheck to paycheck.
Expendable income.
Yeah, you still want to use. It's not to say that like, oh man, never use a bank. Like this, there's absolutely a reason why you would use a bank,
right?
Especially for like you're processing your payments and the basics type stuff,
right?
And you can go to the bank and you can borrow money, and as long as you're using that money wisely, you're most likely going to be fine. But for those individuals with excess income and they're wanting to use it, right? So there's a lot of people in the real estate investment community that will use infinite banking, but any business owner, any investor, anybody that's making money and they want to get better benefit for it, infinite banking is like the place to be.
Absolutely. So what you're saying there is like, yes, we're not saying get rid of your checking account. You need your checking account to take advantage of all of the conveniences of having a technical, especially in today's digital world. Your checking account should have all of your bills that you're paying, all of your expenses, things like that. But what you're saying is above and beyond what you need to have in that checking account to make your life work, anything that you have expendable income, if you have it in a bank, you could be doing so much more for yourself with that money than allowing the bank to make 10x on it and keeping your money and giving you a little piddly here's a quarter for it.
Yeah.
Right. So that is where infinite bank comes in, and that's where the idea of be your own bank came from. Is banks are making money off of your money. Why don't you do that yourself, which you absolutely can do through the infinite banking system. So, Jack, starting here again, you kind of alluded to it there. What type of people should set up an infinite banking account? What is like the sweet spot, so to speak?
Right. So going back to 15 years ago, for me, the reason why it worked was I was really committed to paying myself first. So you've got to adopt this habit of not just paying your bills and then trying to save what's left, which is usually not much, because somehow, some way, we're going to find a way to have our expenses meet our income level. And this is the reason why, so many Americans are ending up in poverty. 70% of our senior citizens spend the last 10 years of their life on Social Security alone because they just don't have enough money in savings.
Right.
I think it's something around around 95% of people by age 65 are not yet financially independent. And it's just because folks don't have enough money saved. So you've got to be in the habit of saving money first. And so I teach classes to help people make sure that they at least, start creating a budget and do that sort of stuff, as a basic thing to go forward.
Right. I mean, if you want to retire well, you have to prioritize retiring well and make that, just like you said, pay yourself first. You're not going to retire well if you spend all the money that you want or need to spend, and then whatever's left over, that kind of, okay, we'll throw that toward retirement. That's not going to create a good result. You have to prioritize paying yourself first.
Right. And, so if we're looking at around 20%, right, 86% of 86% of millionaires are self-made. And if you look at these folks, what they have in common, obviously many different walks of life and professions and all that sort of stuff, but they paid themselves at least 20% of what they were earning. And in some cases, much more than that. But so if you can get to the point where you've got a habit, you are consistently ready to pay yourself and save money, the question then becomes, okay, so what do I want to do with that money, right? And not to say that you shouldn't be using retirement accounts and things that you're already doing, especially if you have matching, if you're employed. But if, let's say you're a business owner, you're an entrepreneur, you're an investor of some sort, real estate investing, you're not going to have that, right? So it's really about just creating that excess savings and then being able to leverage it just like you can leverage other types of assets and investments. I'm going to guess that most people out there have at least heard of a home equity line of credit. They may not have used them.
Right.
But this is a similar concept to that, where you think of, a home is an asset that builds equity. And, down here is your mortgage. And then you've got this equity above it. And banks will allow you to borrow against the equity of your house. So your house is not, you're not like moving your house. You're not, cashing out your house.
Right. You're not just taking money out of the walls. Right.
Exactly. You're just utilizing that asset.
Leveraging.
To take that money and hopefully invest it in another place where you can make money on that as well. And that effectively means that your house is accumulating in value as well as your investment. And you're making money in multiple places at the same time, just like the banks do, right?
Right.
Well, this is kind of like that. You're just using your cash as that asset as opposed to a house, right? So the same entities that do this give our clients this opportunity where they can make market-like returns on their money, right? So they're making somewhere between 5, 6, 7, 8, 9, 10% returns on their accounts. But at the same time, they can borrow against it and they can utilize that money for whatever thing they want to invest in, if it's in themselves and their business or somebody else's business or real estate or whatever, and effectively make money in multiple places at the same time. And collectively, you add all that up, right? Maybe now they're making 20% or 30%, and these entities, when you're a customer of theirs, offer some pretty nice loans. I have clients that will request a loan up to 100% of the money that they have in their account, and those loan rates are going to fluctuate somewhere around like 4-ish%. So that's pretty dang low in this environment.
Absolutely.
Yeah.
So if you had to kind of, if you had to explain to the layman, right, what exactly is an infinite banking plan? How would you do that?
Okay, so first of all, if you're going to look at like just what would be the basic reasons why people do infinite banking,
right?
I would say number one, you have to understand the money is insured, right? So part of the reason why banks operate the way that they do is they have zero reserve requirements, meaning you take your $100,000, deposit the bank. That $100,000 is out the door immediately. Okay, and multiply times 10. Okay, so that's all fine as long as everyone's paying their loans, right? And that's a whole nother story.
Right.
But we feel comfortable putting that $100,000 in the bank because it is FDIC insured, right? It's not something that always existed in our country, but after the Great Depression, in 1933, FDR said, man, we got to do something to get people confident in banks again. And so, when fractional reserve doesn't work, okay, they have FDIC insurance. So effectively what we're doing here is we are going around the banks and going to the industry that holds on to all the money. So we are going directly to the insurance industry. And just like there's insurance companies that insure cars and homes and boats and buildings, there's also companies that specialize in insuring money, right? And so your money is fully insured with infinite banking. And insurance companies are actually federally required. They must have $1.06 for every $1 that they insure. So if you have $100,000 in an account, that company has to have $106,000 to back it up. Okay, just like if your house, say, burns down for some reason. Okay, well, they've got to be able, any insurance has to be able to write a check to replace it, right? So the same thing applies here. So your money is safe.
The insurance companies are actually held to a higher standard in that regard than the banks are.
Right. Most of these companies that I work with that do this, some of the oldest, biggest, strongest companies in the industry and in the world, there's one particular company that a lot of my clients prefer, has $4.50 in reserves for every $1 that they insure. They have $65 billion in total assets under management. So we're not exactly dealing with something that's like a fly-by-night new idea.
And these are also companies that have been around for literally hundreds and hundreds of years.
Yeah. So it is, first and foremost, the number one reason why people use banks is they feel it's safe. And so the same thing applies here. The next reasons why people utilize infinite banking is that they're getting those market-like returns that they don't get from the bank, right? So instead of getting 0.08%, the account that I've had now for 15 years has averaged about 8%. That's a big difference, right?
Your infinite banking account, right?
Exactly. So when you look at the course of time, right, you're going to work hard for all this money. And if the difference between making 0.08% versus 8%, if you look at a compound interest, calculator, we're not talking tens of thousands. I'm talking hundreds of thousands, if not millions of dollars that should exist in everyone's life in the future. but it doesn't because they just don't understand that. So these are two things that right off the bat, infinite banking does for someone. But the next
making literally 100 times the interest that you would be making with a bank from 0.08% to 8%. That's a massive difference, especially when you talk about compound interest.
So we've had a lot of people that have used that strategy just for pure, wealth accumulation.
Right.
Not even necessarily for infinite banking. This is a strategy that for our financial clients, they just like being able to, have that safety, but at the same time still have the opportunity to make better returns. But now we get into why is it that for generations, some of the wealthiest families, biggest companies, and by the way, even banks have been utilizing this strategy? Tax advantages. One of the things that I learned early on in my career was when I researched really successful investors and folks that created massive amount of wealth. These are not just people that learned how to grow their money. They learned how to protect their money. Yeah. We're not necessarily talking about protecting their money from the market, from the stock market. They had to learn how to protect their money from Uncle Sam, from taxes. And so the way infinite banking works is you don't have to pay taxes on the gains. You don't have to pay taxes on the money that comes out. And upon your passing, all of the money that you have in there goes to a beneficiary or a trust, 100% tax-free. So you're looking at creating a plan for infinite wealth, thus the term infinite banking. And the other major reasons that I would say, on top of taxes, would be the fact that you get to control it, right? Because some of you might be out there saying like, well, that kind of sounds to me like a Roth, right? And a Roth is still a sort of a public retirement account, and there's some rules and guidelines associated as to how much money you can put in and when you can access that money.
There's some pretty strict limits to how much you can put into a Roth.
Yeah, and I have a lot of clients that utilize Roth. This strategy is sometimes referred to as a rich man's Roth, and that there is no limitation. So it's all customized and tailored to the individual. So we've had people that put in, $500 a month into that. We've had people that put $500,000 a year into that. We've had people that put, $7,000. We've had people that put in seven figures. Right? Every account is customized to that person and their suitability. Whether they can financially qualify for it. They have to have, legitimate income and or assets to be able to fund it. But so long as they do, that's good. And they have liquidity. Right. So they have control. The liquidity just means that you're not restricted as to how and when you can use the money. So there's no penalties. There's no taxes. You want to use the money to buy a boat? Do it. Right?
Right.
Is that necessarily the best appreciating asset? I don't know, but I could appreciate a good boat. You know what I mean? Like that.
Right.
Like a pontoon, Yeah. Absolutely. But
double pontoon. Absolutely.
but let's say you want to, use that money for some sort of an investment, right? Obviously it's nice to know that you can access that money at any time for any reason without any explanation going to anybody. And so the ability to have access to it, but not just as a withdrawal, right? Most of us are used to, we build up our savings and we need that money, we withdraw it and withdraw
Take it out.
Yeah, and you've withdrawn the opportunity to earn interest on that money anymore. If you start to treat your cash like an asset that never stops growing and compounding throughout all of your life, now you have the opportunity to borrow, right? And so
leverage.
These same entities are allowing you to create that leverage, borrow against that, and use it for investments and make money at the same time.
That is really where I think the magic of infinite banking happens. And this is where, when you're doing your education, you do seminars all over the country, and you educate people about this concept. I imagine where you see people's light bulb really going off and their pencils start to scribble faster and their eyebrows raise is when you start talking about that idea of the money that you are borrowing from your own account doesn't leave your account. It stays in your account and continues to earn interest.
Correct.
Meanwhile, you take that chunk that you borrowed from your account, really borrowed against your account, and you put it into, say, a real estate investment. Now you're earning interest over here on the return on that investment while you're still earning interest here. And that is where you start talking about things like arbitrage, where you're earning more in interest than you're paying in the loan that you took. And that is true leverage. And that's where I think that a lot of people, you grow up maybe in a middle-class family like me, you always hear of wealthy people leveraging, using leverage and using arbitrage, using these fancy terms. And you're like, well, that's not for me. That's for the ultra wealthy. But this is truly a way that you can access the strategies that huge institutions like banks and the multimillionaires, the Rockefellers, right? These same strategies that they've used and ideas that they've used to really grow generational infinite wealth, you can use them through an infinite banking policy.
I get that question a lot from folks, which is if they've not heard of it, right? Because neither had I, right? I mean, I grew up in a small town, and I was just hoping I could spell leverage,
Right.
Understand how it actually works, right?
Exactly.
And so, anyway, when I did research in this, and you actually look into it, currently the 1% wealthiest people in our country own over 1/3 of the reserves of the insurance industry. Okay, so that's just a few people have a lot of money, and they've got it parked within these insurance companies. The top 10%. Wealthiest people in America today currently own 60% of the reserves, if you add it all up. There is over 4,000 banks that currently have over $200 billion, it's like $203 billion currently deposited. It's called BOLI, B-O-L-I, bank-owned life insurance. Okay, and so that's the next topic that we're going to get into here, which is how do you do that, right? But so if banks are doing it and billionaires are doing it, why shouldn't we, and how can we is kind of the next big question, which is like, So how do you do this, and what makes it like not too good to be true?
Right. So let's jump right into that. How does this work for the average person who has some expendable income, and what is the process?
Right. So what makes it not too good to be true? Remember the movie Willy Wonka and the Chocolate Factory?
Yes,
right.
Love that movie.
Charlie had to get that that golden ticket. You're right. Yeah. And so I kind of use that analogy in that, like, to get into this amazing, tasty savings experience,
Chocolate Factory,
right? The savings chocolate factory. You too need a golden ticket, and there is a tax code called Tax Code 7702, which states that so long as you have a life insurance policy with that company, right? So the money's safe, it's insured. They are insuring the money, but there's also a life insurance policy. You are a customer. Okay,
you have to be a customer to get into the chocolate factory.
Correct. So you've got your golden policy. You've got your golden ticket into that amazing savings account. Now, I come from a financial perspective, and usually a lot of times people will sort of balk at that, and it's like, oh man, I got to pay for something. I got to pay for life insurance.
I see. Here's the rub. I got to buy a life insurance.
So so let's talk about that as a catch, right? That life insurance is the reason why you can get these loans, because first and foremost, it protects the entity that's going to give you these loans that you can decide to pay back or not. Because if you never pay that loan back, say you had $1 million. And you decided, hey, I want to take this $1 million and I want to invest it in some sort of like an apartment building or something like that, a syndication. Okay. And then for some reason you never pay that $1 million back, right? So you're making money on your syndication and you're still making money on your $1 million, but you never paid the loan back, right? Well, so how can they do that? I mean, you can actually choose to never make a payment on that loan. Well, if you have a policy with the company, at some point, right, you pass away, well, they're going to be able to recoup what was owed from that loan from the death benefit, and your family receives the difference, right? So it protects the company that's giving you this amazing savings and leverage opportunity. And then secondly, it does also protect your family, right? So this doesn't happen very often, and I don't recommend it, right? But if somebody does pass away, the money that they would have had later in life, right, that money is effectively advanced to their family, with utilizing that death benefit.
Right. That's what life insurance is all about. It's that death benefit. You make a contract with the company, you pay them a premium. There is a death benefit that, in case you pass away, is paid out.
And even though there is a cost for that, it represents a tiny fraction of the overall value that you get from these. And I can show you an example.
That's the cost of the golden ticket.
Yeah, I think I've got an example we can look over later.
Yeah. Because
usually people, again, are like, well, I don't know if I want to pay for insurance. And so there's always going to be a cost, for everything, opportunity costs and that. And, I come from, a financial perspective. So my interest is not for my clients to have more life insurance. In fact, there is a minimum amount you must have based on how much money someone's putting in. And so it's called a modified endowment contract, which, of course, we all know about. Right?
Yes, of course. This is where we get into the terminology.
This is that's an interesting way to describe it, but it's essentially the limit, right? So based on the amount of money someone's putting into infinite banking, there is a minimum amount of insurance that they must carry. And if we use specific carriers that really have more of a financial focus with this, we can minimize and mitigate that cost of insurance down to pennies on the dollar to get entry into that amazing savings. And by the time you see the numbers, you can see where a lot of people see the value in that. And that, yes, there's a cost for it, but it's the golden ticket that gets me tens, hundreds,
Right.
thousands, and millions of dollars of tax-free growth and advantage.
It's just the cost of admission.
And it's cheaper than health insurance. It's cheaper than car insurance and home insurance and maybe even cell phone insurance. And
I think
yet,
it's really getting people past that part sometimes. It's just this is a life insurance policy, and they think that's the catch. It's not actually the catch. It's actually the thing that gives you all of these tax advantages. That when you go back, about 10 minutes, you were talking about the ability to get through this entire thing tax free,
Right.
and people are saying, well, how is that possible? I'll tell you how it's possible. It's possible because it's a life insurance policy, and there are specific codes that allow this to happen. That literally you can only do it with life insurance.
Yeah,
you can't do it any other way.
And when you look into tax code 7702, right, what's funny about it is that, okay, so it was enacted in 1984. Before that, the same principle existed, but they created sort of a new government minimum around how much money you're putting in, right? So
Right.
we're talking 40 years ago, and it's never been challenged, right? So there's a lot of things that change in savings and investment
40
world
years.
and tax and all this sort of stuff. And it's never been challenged, and people want to know why that is. It's like, well, who did I say does this more than anyone? Well, those would be the wealthiest, right? Okay. And
People with the power.
and right. And who do they sponsor? That would be the people that make the laws. So they're probably not going to, sacrifice their best favorite savings account, right? So, however, if it was to ever change, the folks that already had pre-existing accounts would be grandfathered in, right? So it would not affect past accounts. It would only affect those going forward. But I'm really not seeing that happen. So
Right.
we're probably good.
Yeah, absolutely. So let's see. We're kind of walking through the process here. Is this infinite banking? Because we've been hearing about it for. Obviously, it's been really in vogue. It's all over YouTube. It's all over TikTok. It's all over social media. Content creators talking about infinite banking with varying degrees of expertise, by the way.
That's a good point to talk about is honestly, who are you listening to?
Exactly.
And, when I got into this, I asked a lot of people about it. And I know there was a lot of people that had opinion.
Uh-huh.
Okay. But I learned you've got to consider the source. And there are people out there that maybe their focus is insurance, right? And so their interest is going to be, oh yeah, let's get you a whole bunch of life insurance, right? And there's some companies out there that these are not bad companies, right? You see them advertised in commercials and during the Super Bowl, and they might be really good at like home and auto insurance, but if you're really going to do this and do it right, you've got to find specific companies that specialize in this. And so I'm an independent broker. I own my own company, and so I'm not owned by anyone, and I can shop all the different companies that are out there. Some of the best companies that do this are A+ rated, been around for 150, 200-ish years. A mutual company is really important to look at if you're going to do this type of strategy, because a mutual company versus a stock company. A mutual company means that it's collectively owned by its customers, by its clients, right? So now you're a co-owner. It gives you a different position to be in than in a stock company who's focused on profits for its stockholders. So if you're in a mutual company whose board is made up of fellow clients like you, they're obviously going to set up an account that's much more advantageous to allow you to get all those great benefits. And I'm not talking about a small difference here, because, I've seen things presented to me when I was learning about this as a potential client that literally the difference, like similar, like related strategies, but I'm talking about millions of dollars of difference like down the road by understanding these things, right? So and this is where, I saw a gap, and I just saw that, okay, there's in the financial and insurance industries, right? You've got folks that kind of understand investments, don't understand insurance. And then there's people that understand insurance, don't really understand the investment world.
Right.
And here's this that kind of fits in the middle. And I love it because you can leverage it and invest in other things. And yet there's all these people out there that kind of know something about it, but not a lot about it.
Right.
So I decided, all right, here we go. This is where we're going.
And it's you're talking about the importance of picking the right carrier. Now, generally, the most important thing is to pick the right person to work with, because infinite banking, it is complex. I think that's a big barrier that people have to get past. Is it is something that if you're the engineer type who really wants to understand every single thing about how everything works, there's going to be a learning curve, and you need the right person to take you through that learning curve, first of all.
Right.
But if you're not that kind of person, you're just like, I want to pick the right person. I get the gist of this. I see the power in it. I'm not going to worry about the fine details. You really have to work with the right person. That right person has to be working with the right companies, because in some cases, Jack, you're talking about, I don't want to get too granular here, but you're talking about a rider that's available at a certain carrier that is not available at another carrier. And that little rider, that little detail has a massive impact on how that infinite banking policy is going to perform.
Yeah. And there's a lot of companies and there's a lot of brokers who either don't have access to that kind of rider, specifically liquidity for the client and freedom for the client. Either they don't know about it or they refuse to offer it, because it doesn't really affect the client negatively. It helps them. The only thing it affects is how much they make as an individual. And so that's kind of an easy decision for me, because that's what I did for myself. That's what I'm going to do for our clients.
Exactly.
And again, I'm looking at this from a financial perspective, and that's the best way to structure this. And these are not, this industry is not full of a bunch of, bad folks, but maybe their training is such that they're not even made aware of these things.
Exactly.
And again, it's not their focus. It's maybe like a thing they know about, as opposed to it being like the thing that they.
You really should work with a specialist such as yourself, somebody who is living and breathing these things, and keeping up with changes in, what the carriers are doing. But infinite banking is a really hard thing to rely on someone who's doing it as part of other things that they do. You really need to work with that specialist who has their finger on the pulse, who has the track record, the experience, their ear to the ground, and can work from experience to help build these things in the right way. Because the other thing about these accounts is it's not just to set it up and then it's done. You have to revisit these things, right? This is a process that you're going to be revisiting and tweaking and making changes to throughout the years. It's not a set it up and then, all right, nice to see you. Call me if you have any questions.
There is a 100% chance that if you do this right, you're going to own this account for the rest of your life. Okay. And not only that, your kids should also be doing the same thing. I have two kiddos, Jay and Kate. When they were born, we set up accounts for them, and I'm teaching them about saving and all of these same things at a little bit,
Right.
like, as much as I can hold their attention, but they get it. And, as they get older, we'll help them progress. And with these type of accounts, based on the size of the account you open, there is a maximum what you can put into one account, but there is no maximum to the amount of accounts that you can have. So I own 5 of these now. Started with one 15 years ago, fully funded that in about 6 years. There's a minimum period of time that you can fully fund an infinite bank strategy. It's usually about 5 years. But somewhere between 5 to 10 years is considered optimized for infinite banking and picking a number. So, that could be 100,000, it could be $1 million. But anyway, so each client that we work with, we figure out, their situation, their business, what's going to work best for them. Once you hit that maximum, okay, you've hit your maximum of what you can deposit into that one account, but we might be doing multiple accounts, right? And again, once I've taught my kids to do that, they are going to do it, and then generation after generation. And like the Rockefeller family is famous, and there's been books written about this family specifically for utilizing that strategy to grow and retain their wealth for generations. While you've seen, other families that have lost all their wealth, maybe billions of dollars have disappeared because they didn't set up a plan for building that, and then somehow, like one of the grandkids is going to squander it, right? Like this, like they don't know what they're doing, right? They just got born with all this money, and they're good at losing it, right? So you can set this up and utilizing a trust and actually make sure that wealth is built and sustained from generation to
for generations. I mean, it really is. It's a generational thing. It's not. You're obviously going to be a beneficiary of it, but by the way infinite banking works, your children, your children's children are also going to benefit from this.
So if it's that important, you might as well know what the heck you're doing. Right?
Exactly.
Like not just what you're doing, but why you're doing it. Because then that way, my clients, I take my time and I meet with people multiple times and really get to know them, like where they've been in the past, where they're going for the future, what their business is. And, everybody's going to be unique and have different ideas and goals. But if they're going to do this, they've got to understand what they're doing, why they're doing it, to really understand how to get all the best benefit, out of it. Because once you use it, man, it's really awesome compared to everything else you've been doing your whole life, right?
Exactly.
So it really is an awesome experience, and love doing it.
And this isn't anything new, as I was starting to say earlier. Like it's become in vogue really lately.
Yeah.
You're seeing it everywhere, but this has been around decades.
Generations. Yeah. This strategy actually predates our country even. You go back to medieval times, and kings and queens were literally utilizing sort of an archaic version of this type of strategy to protect their wealth from being taxed for the next generation, right? And so it is really interesting. But, these things have expanded over time. And then obviously with like social media and TikTok, these things that are out there, you have more and more information that's going out to people. And I have more and more people now, which is awesome. It's creating interest where more people are calling our office and wanting to know more about it.
Right.
But they maybe have some sort of
sometimes you
unique
find them
slant on how it actually works.
What did
and it's
you
like,
watch?
all right, let's go back to the basics. Let's go through the classes. Let's go through the books. Let's go through this kind of stuff. And it may not be the right thing for everybody at that time. But what I'll do is if I come across someone that's like a younger version of myself that was like, I'd like to learn how to spell leverage, right? And so I love working with folks that are excited for creating financial independence in the future. So sometimes what we have to do is help them refinance their finances, go through the basics, go through the nitty gritty, and make sure that they're in a healthy position financially to get something set up like this. And it's not like impossible for everybody. It's just something you just want to make sure you're doing it the right way.
Yeah, the right way and in the right scenario. So let's actually walk through a bit of an example here, because I know that we've learned a lot about infinite banking. We've kind of touched on a lot of stuff. Take me through an example. We're actually going to put these numbers up on the screen for you guys as we kind of walk through them.
Maybe, or
I think it's going to be full screen. I think it needs to be because the numbers are so small.
Oh, yes.
So Jack, kind of walk us through this illustration, a real life example with real numbers of how an infinite banking scenario might work.
So I have about 1,300 personal clients, and I run a company where collectively we have somewhere around $3 billion in assets under management, right? Not everybody's doing infinite banking because it's not the thing for everybody.
Right.
But we have more and more clients, obviously, that are utilizing the strategy. And so I like to give folks examples of what this actually looks like. And so what I think you're looking at on the screen here is an example of one of my clients that his goal was to put $200,000 into his account, right? So $200,000 going in. Like I said earlier, the goal is to try to get that money in there in 5 to 10 years. So
he had 200,000 just like, hey, I have this. Let me just give it all to you. You said, no.
Can't. Yeah.
Which we could.
If you did, you'd have to do 200,000 each year for 5 years, and your target fund now is $1 million.
Right.
Okay. So this is part of what makes this not too good to be true is that in order to keep all the tax advantages, remember this is going to grow tax-free and be accessible tax-free. We've got to live within tax code 7702. These guidelines state we got to pick a number that we're going to fund over 5 to 10 years, right? And I like to be conservative, right? Because a lot of folks will say like, well, I think I can put $1 million in. And it's like, well, how much money did you make last year? And they're like, 40,000. It's like, okay, well, let's shoot for.
Well, and real quick in general, just life experience. If someone's putting a limit on how much you can do of something, it must be good. right.
Yeah. Well,
I mean, it's just and breaking it up over 5 years is something that I'm sure you actually come across clients that are like, but I wanted to go ahead and do this now, but you have to kind of put a limit on it. So you're telling this guy, break up your $200,000 that you want to put into this infinite banking thing.
Right.
Break it up over 5 years.
This particular guy, right, he had an emergency savings. A lot of people are trained to have an emergency savings. And he had about $20,000, sitting in account, with a bank, gathering dust, right, getting nothing.
Yep.
Right. Got his toaster, but not much else, right? And,
right.
And so we started the account with that, but then we also added to it. So what you're seeing on the screen here is an example of you could do this at $3,333 a month, or you could do it as a one-time deposit of $40,000. But it's not a commitment; it is a cap. That's how much money you can put in up to per year.
Right.
The minimum that you see there is $210,000. there's a $210 minimum per month that he has to put in because of the insurance. Based on his age and the amount of money that he's putting into this account, he was required to have $921,467 of life insurance. Okay. So why is it that weird number? Well, that's because that is down to the dollar, the minimum based on his age and how much money he's putting in, he has to have. So that's the golden ticket. That's the cost. Is he's got to pay this $210 a month. Now, you'll notice once he's put his $200,000 in, he doesn't have to pay for that. It's paid up and paid off. So he doesn't have to pay for insurance for the rest of his life. That's going to be there and be there for a very long time, but he doesn't have to pay for it. So, if he puts in $40,000 the first year, he's hit his maximum. Say his account started in March, right? So by the very next March, on his anniversary date, he can put in another $40,000. But let's just say he puts in 20. Okay, so he doesn't hit $40,000 that second year, right? That extra $20,000 carries over to the next year, so he can allow you to catch up.
He could do 60. He could do
60 in year 3 or something like that. So the whole point is, we want to pick a number that we think we can hit in about 5 to 10 years, right? So if it takes you 8 years to get to 200,000, still works awesome. If it takes you 12 years actually to get to 200,000, it still works really well. This is kind of like crunching everything into the shortest window possible.
Right.
But there's a lot of people, millions of Americans that utilize a very similar strategy to this for basic wealth accumulation, where instead of doing $40,000 a year for 5 years, they're doing like $400 a month, right? Either
for their whole lives.
Yeah, a lot of your audience, or they know somebody that's most likely doing some sort of like a financial portfolio that comes with some insurance, and they're putting in $400 a month. And the idea is in 30 or 40 years, they'll have some extra money to use for tax-free retirement, right? That's what it's known as. This is kind of like that, but we're compressing everything and supercharging it and, getting that turbo boost of compound interest fast, And so anyway, so hopefully that makes sense. But each person's situation is going to be unique, right? So this is just to kind of give an example. And this is a projection at 6.44%. Like I said, historically, we've seen our clients do better than this. My own personal account for 15 years has been closer to 8%. But if this client was to make 6.44%, you can see that after year 5, after putting in $200,000, his account is at $223,000. That is about $23,000 more than he would have had in his savings account, right? Let's just be honest. So he's already coming out ahead. But he's not going to just do this for 5 years. He's going to have this for the rest of his life. And by the time he's 60, his account is worth $747,000. Obviously, what you're not seeing here is the maybe hundreds of thousands, if not millions of dollars of other investments that he's created by leveraging this account throughout his life, right? So this is most likely someone that's going to be financially independent and doing very well later in life, even if he just did this one account. And if you fast forward looking at the next page, which I don't know if that looks on your screen, but if we've moved on to the next page and we fast forward as far as we can, right? By age 85, that account that he never put in more than $200,000 is now worth $3.86 million. And again, that's only at 6.4%. So in reality, we think that should be better than that.
That's a conservative projection.
That ain't so bad. That's 100% tax free, by the way, in case I haven't mentioned that 5 times. But
that's incredible.
That makes a difference, and
the power of compound interest supercharged.
It is wild. I mean, again, going back 15 years ago, when a much more follicled Jack was looking at this.
Follicled.
Is that a word?
Sure, it is.
I am a financial guy, not a words guy. But, so anyway. I was, what I mean? Like that, when I said that that left a huge impact on my life, it was because I was looking at this kind of stuff, and somebody was showing it to me as though it was only for people that were worth millions of dollars.
Right.
And of course it is. And these are the people that do it more than anyone. But anybody can do it.
But anybody can do it. And they just need access to the information and to the right people.
And again, let's go back to that question. What was the catch? You had to buy that policy, right? You had to pay $210 a month for 5 years to have that policy, And so there's going to be people that literally go, I'm out.
I'm out. I don't want to buy insurance. Sorry.
Give me my toaster, right? Give me my 0.08% interest. I'm used to going to the bank, right?
It just doesn't make financial sense when you understand all of the numbers. People have this thing about insurance, man. I got it. You were trying to sell me an insurance policy. Get out of here. I wasn't trying to sell you an insurance policy. I was trying to sell you financial independence. The cost of insurance is literally the golden ticket, and people just sometimes can't get past that. The Dave Ramseys will tell you, don't do this.
Right. Well, and that's where this is what makes the financial industry difficult, right? Because if you talk to a thousand different, financial people, you'll get 1,000 different opinions. So that's why I kind of like to look at the numbers, right? Could you have done better? Sure. You know what 98% of people are doing? Worse.
Yeah.
So, right. Could you do better? Sure. And I hope 2%. You do. Yeah. I hope you do. But I think you should do this too. I think infinite banking is something that all Americans with excess income should own. And it's not an or conversation. So many times when you talk to somebody in the financial industry, right, there's you should do this, not that, right? And it's like, hey, you should do this and that. You know what I mean? Like you got an idea, something you want to do, go for it. Do this too, add a little amplifier of interest in your life and get some tax advantages while you're doing it.
Right.
It makes a lot of sense when you just take the time to really research and learn and figure out how to do it right, like I was saying.
Absolutely. Incredibly, incredibly powerful. So going by this example, at some point, let's say that this guy wants to take out some money of his policy and they want to, he wants to borrow. Let's say that in year 10, he's got a big real estate opportunity. One of his buddies brings him this incredible opportunity that hey, $100,000 to get in on this opportunity. This is where the infinite banking part really sings, right? Because he can start to leverage this cash value that's growing, and that's where you can start earning interest in two places, right?
Correct. Okay, so looking at year 10, this shows $276,000 in his account at that point, right? So you take out a withdrawal. Now we're not making money on 276, right? We're losing that money, right? So instead, we're going to request a loan. And
so the difference between what you're underlining here, very important to understand. The difference between withdrawing money and investing it, and loaning money, an internal loan. All right.
That's that home equity line of credit we were talking about. So the asset stays where it is. It's still going to be there and growing and compounding throughout the rest of our life. And instead of removing that money, right, and withdrawing, we're just going to request a loan. That's a separate arrangement, right? And because we are a co-owner, right, a client of a mutual company, they're giving us this great loan at maybe 4.5% interest, something like that.
You're basically using this cash value built up as collateral for a loan.
Yes. And so then, take out that $100,000. What I recommend my clients do is to, each year at least cover the interest on the loan, because it's 4 or 5% interest. It's not that much.
It's a very good loan.
If you did do a home equity line of credit, it would be double the amount of interest in today's environment, and you'd have to make interest payments. So I encourage people to make interest payments, but you don't have to. Each person's situation is unique, so you might decide you don't want to. And depending on how your business is set up, there could potentially be some write-off opportunities there, but that's more complicated. So anyway, thing is, if you cover that, the loan amount never is going to grow. There's just going to be that simple interest that you pay off each year. And then let's say 5 years down the road, if it's like a syndication type thing, right? So you put $100,000 in, that doubles over 5 years, right? So you turn your $100,000 into $200,000. Okay. Well, you could use that money to start a new account, right? You've already maxed out what you could put into this account. But, that $276,000 that you had in your infinite bank account, right, never left. And now you have $376,000.
Right.
You just made double, right? So we just we made $100,000 in both places, folks.
Even I can understand that, Matt.
Remember
right?
what we started out today? We talked about how banks are making double, right? They're doubling the money that you make on deposit. And I said you could be your own bank, and people are like, I don't know about that. Is it worth it? You like apples?
I do like apples,
you like
Jack.
them apples.
So that is it. That is it in a nutshell. I mean, this is powerful enough without even utilizing the leverage part of it. But once you start leveraging the money that you're building up in these infinite banking accounts, using them on other good investments, ideally good investments, not boats and pontoons, Jack. But but I like boats.
There's tri-tunes now. You throw on that extra tune, go a little faster.
This is where you start unlocking the secrets of the ultra wealthy, and this is where you start unlocking those terms that you thought were beyond your means, like leveraging and arbitrage and all of these fancy terms that are just for the ultra wealthy, right? And this is why infinite banking is exploding right now, because people are being armed with the knowledge. They're starting to learn about these things. And again, the one thing that I will say that's extremely important, At this moment in time, especially, it is very, very, very important for you to work with somebody who knows what the heck they're doing, who's working with the right companies, who has the experience to set these up properly, because you can set these up improperly, Jack.
That's true. And, it pays to know what you're doing and to deal with the right person. And, that would be me. But also there's a few others, right? There's definitely some good people out there. And that's actually a lot of what I do is actually training people, financial professionals, how to be able to do this for their clients. And I love my job. I get to help people with money. Money ain't everything, but it does rank right up there with like oxygen. Yeah. Kind of important. And so getting to help people with money is great. And the other part of my job is teaching other people how to do my job. And so I get to do this for the rest of my life, and it's really fun. I get to see what people do with all this. And I do also want to finish or make sure that we do talk about this before we end, which is the worst case scenario. Like what, people want to know, right? So it's like, okay, so I'm learning more about this and it's great, but what's the worst thing that could happen? What's the worst case scenario? And when you really look at, these are giant billion-dollar companies that are facilitating this, and it's not real likely that these companies are going to go out of business. It doesn't happen.
Right?
The insurance industry, we didn't have
banks go. We have seen banks go belly up.
There's over 1,000 banks that went bankrupt in 2008 and 2009. Right, no insurance companies over that same period of time, and
zero
because of that reserve requirement. Right, and so okay, could this all fall apart? Well, if let's say there was some sort of like a situation where money had no value anymore and electricity doesn't work and zombies are roaming the streets. Yeah, I suppose we got other issues though. You know what I mean? Like, let me know about the other.
Your Infinite banking account won't be the first the first thing you're thinking about. You're probably more thinking about like sharpening a stick.
You're having some issues with your savings account in general in that situation too, right? So I mean, it's as long as we don't feel like that is going to happen, this is among the safest places in the world to have your money. The biggest and worst case scenario, biggest problem, worst case scenario is not funding it. Okay, so if you set up an account to put $200,000 in it or $20,000 or whatever, and then you don't, right? That is actually the biggest problem. And the way that I've structured this particular account, if you look at the numbers that were on the screen, there's a surrender value. Surrender just means that you can surrender this and walk away, right?
Right.
The only money you can't get back, so you can keep the interest that you gain. The only money you can't get back is whatever you had to pay for the insurance. So the worst case scenario for one of my clients is if something happens, right? Not obviously we're not worried about the company, but as far as them and their own lives, if they can't fund it the way that was intended, and they're not going to be able to fund it to where we can even change it, you just walk away with your money. You know what I mean? Like you just go do something else with it, right?
Yeah.
So like I hope that doesn't happen. It doesn't. Like I have not had that happen with a client. Knock on wood.
Right.
That sounds weird.
Right.
But anyway, but that's you got to know that kind of stuff. It's like it's not like we're locking ourselves into something here where it's there's massive commitment
exactly
to something that could harm us, right? I mean, like it's obviously not a big deal if we have to walk away from it.
Well, I mean, I want to mention this, and I hope I don't get too in the weeds. This goes back to what I was talking about. There's a way that you can design these things. You made the comment about you can design them for better commissions for the agent, and that's unfortunately sometimes it's the agent doesn't know what they're doing. Sometimes, unfortunately, it is that the agent might be saying, "Let's do something that's going to sweeten my pot a little bit." Showing zero surrender charges in those first few years is something that you actually do with all of your policies, and you do it for that reason, because you want to be able to show your client, look, you will get all your money back. There are no surrender charges essentially from year one with this policy, but that is due to one of those riders that you actually put on these policies, and you design them that way because you want to give the client that security blanket, whereas others don't put that specific rider on, and the only price really to putting that rider on is commissions to the person who set it up.
Right. And again, it just, I've been in the industry for 20 years, and I got into this industry because I just became massively interested in making sure I understood how these things work. And so I'm really glad you're not hosting a podcast where you ask me about all the other complexities of life and parenting and marriage. And let's just, we can talk about boats, golf, you know what I mean? Like, fantasy football.
Yep.
But, but this is the thing that I know a lot about. And, there's definitely, a right way to do it, in my opinion, right? And when you look at the numbers, it backs this up. I come from a financial perspective. I'm a co-owner of a registered investment advisory firm, and I'm looking at this as a financial strength of benefit to the client. And the insurance is a requirement. It is something you have to have. But there's a right way to do it, and there's right companies in which to partner with and do this correctly. And I don't know if you were going to ask me about this, but
yes,
this is. I think we were talking about it earlier, out back over here. And that because I already know this because this is in the comments of this video, right? This is going to be on YouTube or somewhere.
Almost guaranteed.
There's going to be some comments of other financial professionals wanting to start pouring into the nitty gritty. I must,
Every single infinite banking piece of content is going to have people in the comments that have a different thought about a different way it should be done, and it's always fire and brimstone. So let's just get ahead of some of those things, shall we?
Right. So whole life versus IUL. Let's get into it.
Let's go.
So when you're one of those folks like myself that when you get into something and you massively research it, right? So I've every video that's out there for the most part that has any good amount of views I've seen. The books I've read, the podcasts I've watched. You know what I mean? Like all the stuff, right?
Not to mention all the policies that you've read.
And it's almost like this industry is full of people that believe that there's only one way to do it, right? And I'm just. It baffles me because I'm like, I've got clients that have both, right? There's nothing wrong with having whole life and there's nothing wrong with having IUL. The difference is, what are you looking to do? What are your specific goals and what works best for you? There are strengths and weaknesses, and it's not good and bad. So, when you do research and you look into these things, it is presented and it can confuse people because there's going to be one website that says this is the greatest thing ever, and then this other website is going to say no, that is horrible, like nasty. Don't do that, right? And then, but you should do this instead,
right? And
you should always consider the source because when you look at the bottom of these articles that are written. This isn't written by my clients. This isn't written by people that actually did this right. You're not seeing the billionaires and the banks writing, stay away from this.
Right.
They're doing it, right? The only people that are saying not to do it are folks that are trying to convince you to do something else, right?
Exactly.
So here's all this to say. There's merits to both sides. And as an independent broker, I have the opportunity to make sure that my clients fit best where they want to be.
Right.
But I will say I have more and more clients over the years that have leaned towards the IUL side. And the example that I was giving earlier was utilizing an IUL. Me personally and many of my clients like that strategy because you have the opportunity to earn indexed returns, to be able to tie your returns to an index, for example, like the S&P 500, very popular to use because it's going to go up more than it's going to go down.
Just historically, that's just a fact.
The negative is when the market is down, you do not have interest added to your account. Okay, so there's like a floor underneath your feet protecting you and the money that you put in from losing money due to market performance, right? And if the stock market was to go down and never go up again, that would be a problem.
Right.
But
that would be a big, again, to go back to the zombie scenario.
This is kind of
if
like
it went down every year and never went up again, that would be a problem.
What else would you have invested in and done well? You know what I mean? Like cash under the mattress isn't even worth any money if it's not worth anything, right? So it's like, okay, so if we eliminate that. If you look back at history, and we've got quite a few years as a country now to look at, like, what did the S&P 500 do during like every 10-year period of time? The stock market is usually up about 7 or 8 years out of every 10. So what that means is in years like 2008, when the stock market gets cut in half, our clients just made zero interest that year. So it's we refer to that as zero is your hero.
Because, wow, you were thrilled to be making zero interest in 2008. Anybody would be.
Okay. So, but guess what happened after 2008? Stock market almost only went up, and our clients went up, and made really good returns, and 6, 7, 8, 9%, and then certain periods of time even double-digit returns. And there's different indexes that you can use and all that kind of stuff. But just on its face, if you look at that at not a 1-year period of time, right? Because it's really difficult to try to time things and predict or whatever.
Right.
The advantage to the whole life side is that there's a fixed interest and dividend, which is adds a little bit of extra interest on there, and so that's going to be solid. Market up, market down, you're going to make it 4 or 5%, somewhere in there.
And it's going to be a little more boring than the upside of the IUL, but it's going to be guaranteed and consistent,
safe.
Right.
When you look at the IULs over a sustained period of time, 10, 20 years, right? Conservatively, they're going to make somewhere around 5-6% at, like, if you are really kind of trying to look at it a very negative, like worst
very
case
conservative
scenario, like 5-6%. And that's the best case scenario for whole life, right? But at least the whole life is guaranteed at that
You're not going to have any zeros in there, right?
So a lot of my clients, right, and this is, again, who are you looking at, right? I have a lot of clients that put hundreds of thousands of dollars into these strategies, and they are investors, they are entrepreneurs, they are business owners. The risk of not losing money to them is a lot smaller than the risk that they are taking every day doing what they do for a living, right? So when I explain to people, it's like, hey, you have the opportunity to make higher returns here in the IUL, right? And you're giving up the opportunity to get this fixed interest rate, right?
Right.
But you could get zero if the market's down. They're like, oh yeah, okay, give me that thing that, I mean, when you look at the compound effect, right? And you look at any compound interest calculator over the, 10, 20, 30 year, 40-year perspective, we're talking hundreds of thousands, millions of dollars of tax-free returns that could exist, just by getting to squeeze that extra 2, 3, 4% annual return.
Absolutely. Absolutely. And so when you talk about risk of IUL versus whole life, risk, it's like the risk of hurting yourself between walking and just standing still. It's right. Technically,
we're not taking big
standing
risks
still is zero risk. And technically, compared to that, walking is a risk, but we're not talking about an actual, a true risk. Risk is kind of subjective, right? So
I have clients that do both. That's kind of the point. And I work with both.
Right.
And, I definitely have had clients that have said, I would really prefer to be on this side. Whole life definitely has a stronger death benefit, right? It's designed to be a stronger death benefit. And so if somebody is much more, let's say, interested in making sure that they have a solid death benefit and they're not as much worried about the long-term cash growth, then that's definitely going to be the way to go. And that is sort of the original, the permanent version of insurance is whole life, right? Universal is something that really started to pick up steam after the 1980s, as insurance companies were looking for a way to help people get better returns.
Right.
And so it's sort of the newer kid on the block for crediting strategies, but it's definitely become a lot more popular for those folks that are wanting to get that better return. So anyway, there is no one thing that does everything. That's for sure.
And just in general with finance, and I'll say this quickly and then we'll wrap. But in general with finance, my experience has been if somebody is telling you very strongly like this is bad and this is good, you have to be wary because the financial spectrum is something where you should be always looking for the way to take advantage of lots of different things. And generally speaking, there are not bad financial products. There's just bad application of financial products. So find somebody that you trust, educate yourself through their knowledge. And, infinite banking, I think, is something that is, it's fascinating. It is something that is very in vogue right now. It's something that you do need to do with somebody that you trust. It is not for everybody, as you said, Jack, but it's for a lot more people than you might believe.
And anybody can become the right person, and
right.
And like I said, if the unforeseen happens, right, then in your life as a client, we deal with it then. It's not like we set this up and it's like, hey, best of luck to you.
Right. Yeah, exactly.
It's like, hey, when you need to use this, give me a call, right? And I've got myself and a staff behind me and a team that I work with. And, like I said, I get to do this for the rest of my life. And I want to hear about what you're doing and how you're using it. And, and we build those relationships over time. And, if crap hits the fan, we'll deal with it then, right? Yeah. But it's probably not a good way to be successful in our life if we're always looking at the what ifs,
Exactly.
What's the worst that could happen? It's like, what's the best that could happen? Let's look at that way. I prefer to live life that way. And then, when the bumps come along, and they inevitably do, right? We pivot, we move, we change, we do whatever we got to do to help you get where you want to be. Because everybody wants to be financially independent. And there are different ways to do it, right? But nobody disagrees with the fact that everybody wants to be there. Everyone wants to be financially independent and get to have the freedom to have control over their life financially. And this is a very important tool to help you get that done.
The one thing you can't do is stand still.
That's right.
If you want to get somewhere, you got to move. And don't let the fear of the what ifs paralyze you into doing nothing.
That's right. Yep.
Jack, if somebody wanted to reach out to you and talk to you about infinite banking or anything else that you can help them with on that financial spectrum, how would they do that?
So I've got quite a bit of information on our website. You can go to infinitebankaccount.com.
Okay.
Or jackwaldronfinancial.com. So like I said, we do more than just this, but those things all go to same website, just different pages.
Absolutely.
But reach out to me. There should be access to my calendar on there. Calendly is amazing. I don't work for them, but man,
it's fantastic.
I need to get like a code. I send so many business owners to them because
book a time that works for you. Here's my calendar. Pick a time.
Yeah, you want to come to the office, right? Come to the office, right? It's booked. If you want to set up a Zoom or a phone call, it's all there. Mm-hmm. Our first step is just going to be get to know you, right? Like figure out where you've been, what you've been doing, what kind of experiences do you have, what sort of habits do you have, good or bad, right? And
right.
let's get it all out in the open. Let's talk.
Yeah.
And then it's okay. Where are you at today? And then ultimately, what everyone really cares about, the reason why we're talking, right, is not to. I do have some good tips for your fantasy football teams, maybe your golf swing. But you're probably talking to me because you want to be financially independent. So let's talk about the goals, right? Let's get to the future.
Yeah.
And we're going to take a lot of notes. We're going to ask a lot of questions, and and then we're going to do some research, and we're going to have multiple meetings and report back and make sure that we find the thing that fits perfectly. And nobody does this. Nobody works with me unless they've got that relief, knowing like, man, I'm in the right place for the right reasons.
Exactly.
Otherwise, we don't do it. So anyway, the first step would be, jump on the website, do some research. Let's have a chat. There's no cost. We get paid to do this. The companies that set this up, right, they do make a net profit, right, and they pay us out of those profits. So my clients never have to pay me a fee or anything to do that. And so if you're willing to invest an hour of your time, I'm willing to invest an hour of mine to, help you out and figure out what we can do.
That's awesome. Yeah. It's something you've been doing for 20 years now, Jack, and thank you for everything you do for your clients. Thank you for everything that you do for us, and thank you for being a part of the Alliance Group podcast.
Thanks, Sam. My pleasure.
We're going to have Jack back many times in the future, I'm sure. But again, if you want to learn more about Jack's services and what he can provide, it's infinitebankaccount.com.
Correct.
And jackwaldronfinancial.com.
Listen to this interview and more on the Alliance Group podcast.